Hey, how's it going, everyone? My name is Amos, and welcome back to Dividend Compounders with Cheese. With a simple search on YouTube, there's already a handful of videos on this topic. But here's my take on which stocks will go up when rates go down. But before we get into that, last time I uploaded a video, which was about like 3 weeks ago, my Seattle Seahawks were undefeated at 3-0, and my Hotspurs were looking like a hot mess. Now the Seahawks are 4-3, but it's okay because they're still leading in the NFC West. And Tottenham, well, they're looking okay. They seem to be a 50-50 team. Depending on the day, sometimes they can win, sometimes they can lose. What you see are the past 5 games and their form right now, and they are in 7th place in the Premier League table. So I'll leave it at that. Tottenham Hotspur, ups and downs as a fan. So, where have I been? The wife and I went on our annual vacation, and fortunately for me, it couldn't have come at a better time because I was experiencing burnout from running 2 different YouTube channels, going 100 miles per hour for over a year straight. And we decided to visit Seoul, South Korea. And I will say this, at this time of the year, it's absolutely perfect weather and an underrated vacation spot. See, I live in Asia, more specifically in Japan, and I think Thailand gets so much hype. And as a guy who has traveled up and down Thailand, I can see why. However, when it comes to Korea, I think most people and travelers are sleeping on Korea because, hands down, I think Korea's food scene is unmatched. The diverse options and tastes better than anything you'll see in Asia. And I know that's an unpopular opinion. And can I just tell you, I just turned 33 years old, right? And I finally feel my age because when I was younger and I was backpacking all over the world, I could go all night exploring the city and then crawl into bed at 3 a.m. to wake up at 7 a.m. to do it all over again. However, this time around, the wife and I would call it a day at about 7 p.m., and we relaxed in the hotel rather than going back out. And I know, if you're like 61, you're probably hearing this and saying, dude, 33 is still really young, but I'm not a 21-year-old anymore. So as a 33-year-old, I gotta say this. Getting older is such a weird feeling. Anyways, circling back to the whole YouTube burnout thing I was talking about earlier, the thing is, I love making content. The research that goes on behind the scenes, the interaction with the community. By the way, I love when you guys comment on videos and sharing with the world my little PowerPoint presentations. Some of you might find this cringe, but I actually really enjoy the little magic that I make that I get to share with you guys. However, my obsession over numbers and metrics was not healthy. In fact, it would keep me up at night thinking about how I have declining viewership numbers, how I didn't get as much subscribers with the last upload, and it just wasn't healthy. But what's funny is, as a full time YouTuber, I am my own boss and employee. And as an employee, I am hardworking and do all the necessary things. But as a boss, I am an absolute jerk that has impossible expectations. I put way too much pressure on myself to meet and exceed certain KPIs, which is ironic because in the corporate world and in the army, I feel like I was an awesome boss. I was compassionate, understanding, flexible, and I still got the job done. No matter what the mission was or task was, if you left it to me and my men, we were going to get it done on time. So tell me, why am I so demanding and mean to myself as my own supervisor? It just doesn't make any sense. That being said, it's something that I'm going to be working on through journaling and reflecting on the idea that we're all just kids growing up and going through life for the first time. And most of us, yeah, we're trying our best. Sometimes there's going to be good days, and sometimes there's going to be bad days. But that's the very nature of work itself. It's not always going to be a rosy and happy picture. Also, I need to remind myself the art of patience because I'm not going to grow to 1 million subscribers overnight. This channel, objectively, when I look at the numbers, it is slowly but surely growing in the right direction. And I gotta say, that is good. And I forget that all the time. As you can see on your screen right now, about a year ago, I decided to upload videos onto this channel. And in the span of 1 year, I uploaded 120 videos. Yes, in about 365 days, I produced edited and uploaded over 100 videos, which is absolutely bonkers. And that's because I took no weekends off, no holidays. I was constantly working. And what's funny is, in the beginning, I wasn't as good. Right? It would take me about 20 hours to produce just one video. However, I've become more efficient and optimized my operation to now where it takes me about 8 hours for one video. All that to say, while I'll still keep metrics in mind, I'm choosing to evaluate myself based on effort, which feels like a more reasonable and fulfilling approach because effort is an intangible where I can just wake up to each workday and say, hey, I'm going to give it my best today, and that's what matters. Because if I live and die by the numbers, I feel like I am setting myself up for disappointment week after week. However, if I am evaluating myself based on my effort, that's something that I know I'm not going to let myself down on because I am a pretty hard worker. And can I just tell you this? Some good news. After the vacation, I'm feeling so refreshed and ready to go at it again with a ton of new video ideas. I'm not exaggerating. I've come up with so many video ideas during that vacation. I know, pretty bad of me to be working during a vacation, but it just happens. And I get a little sad because, of course, there are still only 24 hours in a day. But the important thing is, I have a whole slate of new ideas, and I'm feeling excited and motivated to do this YouTube thing again. And by the way, when I talked about 120 uploads in a year, that's only for this channel. That's not including my other channels that I'm uploading videos onto as well. So when I think about the past fiscal year, I probably uploaded somewhere closer to 250 to 300 videos. And here's my confession to you. I never thought I would miss the comforts of dropping a protein bar in my own bathroom and sleeping in my own smelly bed, which is funny because the older that I get, the more that I am becoming a homebody that spends more time at home because, after all, I work from home. And I finally resonate and realize why so many people say that there's truly no place like home. The whole hotel lifestyle is fun and everything for the first night or so, but after a few weeks, it just gets old, right? And I just wanted to sleep in my own bed again. Now, on to the video. Not too long ago, the Federal Reserve began the process to cut the interest rates, and in a predictable world, those cuts will continue to come as long as inflation is a problem. So, the first interest rate cut happened on September 18th. November 7th will be the next rate decision, but we've been seeing how the markets reacted to this most recent rate cut. In the span of about a month, from September 18th to about October 23rd, the market is up by 3%, as you can see on your screen right now. Please pay attention, Michael. This is important. Now, mind you, most people that invest into the stock market, they're going to be happy with getting a total return of about 8 to 10% in a single calendar year. But the rate cut caused the market to go higher and higher. So don't tell me these rate cuts are priced in because the market is only going up after the rate cut. And I'm not a genie in a bottle because if I were, I would wish myself to be a little taller and a better baller. But I think the markets will reach a new high in November when that new rate cut decision comes, and then again after the next Federal Reserve meeting and so forth. So which sectors and stocks do I think will benefit the most from these interest rate cuts? What you see on your screen right now is the table of contents. If you weren't paying attention, you might want to look at the screen right now. And unlike other popular finance YouTubers that tend to pump their own portfolio stocks in almost every single upload to the point where I don't even want to watch any of their videos anymore, instead of doing that, I'm going to be giving my best educated guess on which stocks will be the winners, regardless if I'm invested into it or not. Now, mind you, I could be wrong because I'm the special type of stupid that resigns from a $200K a year job to do YouTube instead for minimum wage, chasing that passion dream. Stupid. So please take this presentation with a grain of nipple. First up is the real estate industry, and more specifically, REITs. REITs are known for their dividend. Juicy and delicious dividend yields, such as 5% or even 8%, are not too crazy. And as a matter of fact, that's considered normal for a REIT. And that's because by law, at least 90% of a REIT's taxable earnings have to be distributed to the shareholders as dividends. However, when interest rates were high, big investors rotated out of REITs and put their money into treasury notes and bonds for a safer dividend. The thing is, when the interest rates drop down to 3% or even 2% in a span of about a year or so, that's when REITs will become desirable again. Can we just please make REITs great again? Yes, I might as well get that tattooed on my left chest or something, but my guess is that they're going to trade at a premium multiple once again as soon as their dividend yields surpass the Federal Reserve's interest rates. Case in point, during the high interest environment, REITs were not the best performers, as evidenced by the Vanguard's ETF, VNQ, which is a collection of REITs based in the US. In the past 5 years, the total return for their adjusted stock price has been 22%, which is atrocious, horrible, and disgusting. But if you are anything like me, then you were probably scooping up these REITs while they were on a discount. But with that said, the bigger reason as to why REITs will excel during a low interest environment is because by nature and design, REITs tackle on a lot of leverage to make money. By taking out loans, they buy more properties to rent out, to do renovations, and updates. So if high debt is the name of the game for real estate companies, then high interest rates are terrible for business. If you're not tracking, think about it like this. Would you rather buy a home at 500K with a 7% mortgage rate, or would you rather buy that same home when it's on the market for 300K with a 2% mortgage rate? I know, that's a super simple example, but hopefully you get it. And if you're not nodding your head, then what you see on your screen right now are the winners in my opinion. I am absolutely missing a few, so let me know in the comments section what you think which REITs are the best. Number one, we have Realty Income Corporation, ticker symbol O. Number two, we have Crown Castle International, ticker symbol CCI. Oh, and by the way, Realty Income is in the business of the commercial side of real estate, and Crown Castle is in the business of renting out cell towers. Number three, we have Park Hotels and Resorts, ticker symbol PK, not Pastor Kid, but PK. It's a hotel REIT with 41 properties in their portfolio. And then number four, we have McDonald's. I know, this is not a traditional REIT, but McDonald's is in the business of renting out their assets to their franchisees. As such, I'm going to label them and categorize them with these people right here. You don't buy into McDonald's for their Big Mac or the French fries. Rather, you buy into McDonald's because they're low-key a real estate company. They have some of the most expensive lands and buildings around the world under their portfolio. The McDonald's in Paris, New York City, San Francisco, yes, they all belong to McDonald's, the land and the buildings. And out of this group, if I had to just pick one, I would probably go with Realty Income Corporation. A close number two would be CCI, Crown Castle. Next up is the utilities sector. No doubt about it, utility stocks are rebounding as you are watching this video. And I think utilities are going to be awesome in a low interest environment. More on that here in a little bit, but utilities are the definition of an oligopoly and sometimes monopoly. If you want lights on in your house so that you can see yourself in the mirror as you shave your curly face pubes, then you gotta pay your electric bills. Unless, of course, your idea of fun is to try shaving in the dark and walking into work with band-aids all over your double chin. Fun fact, this actually happened to me because one time I was going through a sad and dark day, and so I decided to shower in the dark. Yes, very unusual and weird, and I remembered that I had to shave my face to go to work the next day, and I did shave it, and in the process of doing so, I had like 20 cuts all over my face, and I looked stupid. And that's why the next day I decided to invest into an electric shaver, but that's neither here or there. For a utility company to be successful, they need to continuously be repairing and upgrading their equipment. In other words, this sector is capital investment heavy and relies on debt to update and modernize its infrastructure. Most utility companies are making a pivot right now into investing into solar, wind, and hydro sources of energy. the green energy movement. And in order to do that, it takes a lot of money. So lower interest rates mean better loans for these utility companies. And that's why I was saying, hey, this is going to be awesome for the utility sector. That way they can change and upgrade all of their equipment in order to meet the power demands of data centers and residential homes and your dingy little 50-inch TV as you root for your favorite sports team that you know is going to lose and have a losing record for the rest of the season, but you still love them and you support them through the highs and the lows and the thick and the thin. And unlike most industries, the government usually gets involved and dictates how much a utility company can charge. And because of that, the profit margins aren't as juicy as what you might see from the health insurance industry or even software service companies. But nevertheless, similar to REITs, investors usually invest into utilities for their sustainable dividends. So as they rotate out of treasury notes and bonds, they're going to be investing into utilities instead. So who are the winners in the utility sector? Well, I think it's going to be Dominion Energy, Republic Services, Waste Management, and American Water Works. Two of these are in the business of recycling and getting rid of your trash diapers. This one is in the business of purifying and treating water. And then, of course, Dominion Energy helps power homes and commercial buildings on the east coast of the US. Now, out of this group, if I were to pick just one, then I would go with American Water Works. A close second would probably be Republic Services, ticker symbol RSG. And if you don't know, trash is a phenomenal business. And no, I'm not talking about your ex-wife. The garbage operation is a predictable and reliable subscription service, much like Costco's membership. And Wall Street knows this, and that's why Republic Services and Waste Management usually trade for a premium multiple. The next sector I am bullish on is tech. Tech companies, for the most part, often rely on cheap capital for R&D, cheap loans to expand, grow, and experiment, to push for high-risk, high-reward endeavors. And when there's a lower interest environment, that means lower borrowing costs make it easier to finance growth initiatives like buying out the competition through an acquisition. When they have access to cheap loans, tech companies are going to take advantage of that. And when tech companies have access to cheap capital, big investors are more likely to gamble on these speculative businesses. So if a company has a bright future, a sexy CEO, or hypes up their product or service but has terrible finances, more investors are going to be willing to invest into them. However, I'm going to say this right now, I played that game before and I lost huge. And that's why I try to stick to my values and my investing thesis, because every single time that I deviate away from that, I get hurt and I get burned badly. And that's why I'm a huge advocate of dividend investing. So with that said, a safer alternative is going to be big tech. And I think out of big tech, these are going to be the big winners, regardless if the interest rates are low or high. We have Google, Apple, Microsoft, Nvidia, and of course, Amazon. And if you're wondering why the logo for Amazon is the smallest out of these five, well, that's because I don't like the company. But I cannot deny that Amazon is a great business. Personal feelings aside, of course, but I hate them. I wouldn't ever want to work for them. Out of this group, if I had to pick just one, by the way, I had to record this video 3 times. The first time took me about an hour and 10 minutes. The second time took me about 40 minutes, and that's because the files kept corrupting. This is the third time that I am recording this video, so at this point, my voice is pretty much gone. At this point, I would rather have someone put a burning candle to my right nipple than to be doing this all over again. Technical difficulties are just shoving themselves up my butthole. But anyways, out of this group right here, I think the winner is going to be Google. I know, the hype right now is around Nvidia, but it's going to be Google for me. And as of right now, out of these 5, I think they are the most undervalued. A close number 2 will probably be Microsoft. Depending on the day, Microsoft could be number 1. But as of right now, as it stands, Google is it for me. And as a reminder, all 5 of these companies are amazing, and they're all going to do fine in the near future. But picking the winner amongst the winners, yeah, it tends to be controversial, I know. The last sector that I think will benefit from a low interest environment will be the consumer discretionary sector. Consumer discretionary are brands, items, and services that people don't necessarily need to survive, but they buy them anyways. Video games, expensive jewelry, Panda Express, you get the picture. So, why do I think consumer discretionary is going to do amazing once the interest rates go down? Because in a perfect world, with rate cuts, that'll lead to lower inflation, which means the purchasing power for consumers will go up and they will be able to buy more crap. Now, I could be wrong because I only got a B plus and A minus in my college level economics classes, but that's what I think. So once the value of my dollar is stronger and the prices of discretionary items come back down to earth, then I, for one, yeah, I'm really big into board games and books right now. And once I have a stronger dollar in my wallet, I'm going to be using that dollar to add more items to my hobby collection. But that's just my own personal example. Other people are going to be shelling out thousands of dollars to remodel their homes, to buy a new car, to upgrade their phones, what have you. So, what are the winners in the consumer discretionary category? Well, I think it's going to be Starbucks, Tesla, Target, Marriott, UPS, and Devon Energy. Sugary bean water is an investing thesis that just writes itself. And when the economy improves and people's finances are better, they're going to be inclined to take more vacations, which means they're going to be staying in hotels and not in Airbnbs because everyone, including my ex wife's boyfriend, we're sick of the laundry list of things that we need to do when we check in and check out of an Airbnb. Like we need to do the dishes, we need to take out the trash, and it's just too much going on. So I, for one, would rather go into a hotel than check into an Airbnb. And then with UPS is a direct or I guess indirect play in the economy doing well with people shipping more things all around the world. And with Devon Energy, the same thought process. And then there's Target. They're doing fine right now. And I think since the pandemic, late 2019, their sales have increased by over 30%. But as shoppers have better purchasing power, they're going to pivot from shopping at Walmart and go back to Target. So out of this entire group, if I were to pick just one, I'm going to have to go with the retail giant Target. I might be wrong, but that's what I think. The thing is, in theory, people say that you cannot time the market and that the market can stay irrational longer than you can remain rational. Logic doesn't really work when it comes to the market. And some people go as far as to say that all of this is already priced in and it's a waste of your time to speculate and to guess and to forecast. So, what is my personal plan? Well, I'm going to be picking up beaten down high quality companies that have been struggling during this high interest rate environment because their rebound and moment to shine is back into full effect. I'm eyeballing a lot of different industries and sectors, but I like to invest into a company when they are undervalued. And right now, I think there's a handful of hidden gems in the discretionary spending category. That's the sector that I am most bullish on, alongside with big tech. Realistically, though, I'll continue to invest into dividend compounders. The metrics for what makes up a dividend compounder is what you see on your screen right now. Regardless of the rate cuts, if a company has that cheddar cheese and pepper jack smell, then I'm going in. That's who I'm going to be investing into, dollar cost averaging. So to wrap it all up, when the Federal Reserve lowers the interest rates, then there will be cheaper loans available on the market. That means businesses that need loans to expand and grow are going to thrive. That also means people will have more purchasing power as inflation goes down. And lastly, as the interest rates go down, so will the Treasury notes yield, which will be a good thing for high dividend stocks because the rotation from Treasury notes to dividend stocks will happen. So, what do you think? What stock or sector do you think has a bright future because of the pending interest rate cuts? Let me know because my 4 brain cells are the most excited about these 4 sectors that we talked about here today. But remember, I could be wrong. I have been known to be pretty stupid from time to time. Anyways, I love you. Stay strong and keep doing the right thing. And I'll talk to you next time, my friend. Stay safe.